Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey everyone, welcome back to another episode of the Tall Oaks podcast. Today I am joined by a friend of mine, Cliff, from out in New York. He works at a RIA or investment shop out in New York. Focuses on financial planning, and his practice a lot less portfolio management than maybe I focus on, a lot more planning. So Cliff and I actually met on X probably a year ago or so, Cliff.
Yeah, I feel like it's been a minute.
Yeah, it's been a minute. And so we're just professional colleagues that have connected and share ideas, which is a great thing, I think, for the industry. Cliff writes also, for anyone that's interested, what I think is probably one of the most catchy or clever titles for a newsletter. He kind of writes it for a younger audience of investors, and it's called Yield to Maturity, which is obviously a play on, bonds and fixed income instruments. Super clever though. Got to hand that one to you, by the way.
Yeah, thanks, Fred. It's a good one. I was looking for one. I came up with it a couple of years ago. Obviously, my target audience really is the younger investor, the younger people, the younger generation. So it worked out well. I still think it's funny, but I'm going to have to figure something out for when I turn 30, because I don't know if it's really yield to maturity anymore.
I think in this business, the 30 is still quite young.
Yeah, that's true.
I think the average age of a financial advisor now is creeping closer to like mid 60s or 70s, almost 70 even. Less young people coming into the industry that are doing real good advisory work and financial planning. Really big shift in the industry happening that way. Not that we're here to talk about that. What we are here to talk about is something that Cliff and I have in common is we're both in graduate programs. So I don't know how you wound up in a graduate program per se. I know for myself, I was like, I had time left on my GI Bill, and I was like, hey, interesting. I joke, I call it a side quest. I'm kind of a closet nerd, and so I'm like, it's a little side quest. Do the Masters of Finance, and yours is an MBA program, right?
That's correct. Yeah, it's MBA with a concentration in finance. So
okay,
I assume very similar.
Yeah, and so we were joking about this because there's all this nuance that happens in academia that as practitioners we're like, wait a second, hold on, there's this sort of disconnect, and I think we both have seen that a lot this last year. And so the one that you brought up recently was this idea around like private credit. Like the program is teaching you, or really having you talk to and design what they perceive to be the value add of private investments in a overall portfolio allocation for clients or customers, right?
Yeah. That's essentially it. I'm not sure exactly what your experience was, Brendan, but like I know for us, what struck me, or what was so like interesting to me, I was signed up for this behavioral finance class. I really like DeFi. It's something that I like. I think as planners, it's probably one of the most relevant things to our everyday and working with clients and such.
Yeah.
And we spent 3 weeks covering private equity in a behavioral finance class, which was a little odd to me. I just seemed a little off color. I was like, oh, really? Private equity in DeFi. Okay.
Well, I think it's like, I think it's way off. I think it's way off collar. Like it's way off topic, I think. But it's relevant to the current conversation and the current landscape, right? Like, and I think in particular, the demographic that you work in with younger investors, and we tend to work with a number of younger, I'm going to use like air quotes, younger crowd here locally as well. And there's a huge focus and interest on like the private stuff. It's perceived to be very, for lack of a better term, like sexy. It's interesting. It's the stuff that you want to, brag about at a I'm in St. George, Utah, so there's not a lot of cocktail parties, but normally people say it's the stuff you want to brag about at a cocktail party, right?
Exactly. It's golf
Like,
course talk, you know?
yeah, no one shows up to the party and says like, man, my silver allocation is ripping this year, right? Like, no, like, no one says, hey, I've had such a low volatility ride in my bond allocation this year. It's been an awesome 7%. It's like, no, that's not this kind of stuff you brag about, right? You brag about like, hey, I got access to owning whatever, shares of SpaceX or, whatever crazy thing, or, I put money in some hedge fund that no one else knows about, or I put, I got it in this private, syndicated construction they're building apartments or a new hotel or, whatever, or private credit or private equity, venture capital, whatever, all this stuff. And what's interesting is like it's consumed so much of the conversation. And I think largely because the stock market has been, and I'm using some air quotes here on the stock market, has been boiled down to in the perception of investors as the stock market just means S&P 500. Why would you buy anything else, right? Like there's been, again, air quotes, no other game in town. And so people are like, hey, what's the next exciting thing to do then? Because the public markets are no longer exciting. Well, you got to go private. And so now there's all this focus and it's really opaque,
Yeah, I totally agree with you. I think that there's, kind of this allure of exclusivity to the asset class where, just like you were saying, it's something that maybe you want to bring up or it's cool or I have it and you can't have it. But for me, and especially at least in the MBA program, it was interesting to see how we covered it. And very young MBA class, like all around. I'm 26. I know that there's a lot of kids that are doing accelerated MBA programs. Doing a 5-year undergrad plus an MBA stint so that they can kind of get it done. Really, just tons of emphasis on the asset class as a whole. And it was funny actually, Brendan. You'll probably appreciate this in talking to my group because we had to do a presentation on the asset class. I was telling them my thoughts and feelings around it, and I was like, I think that we might really only be covering, like, we're really kind of just covering the pros here. Like I haven't really heard any negative takes on it, any potential drawbacks. Really, just like it's private equity, private credit, all this stuff. And in talking to a couple of my pals that were in my group, they were like, dude, I'm so happy you said that. I would have never, ever had this, kind of alternative view on this asset class that is really seemingly we're just glorifying it to some extent in throughout class.
Yeah. That's, it gets glorified. And so I think what's interesting though, is like it rears its head in behavioral finance class because they perceive that there to be this behavioral benefit, which I think is the most, I'm looking for a nicer way to say it, but I think it is intellectually corrupt. To say that there's a behavioral benefit to, private credit or private equity or private investments, right? And essentially what it boils down to is this idea of, hey, since it doesn't get repriced every day, right? You can't really check the value. You can't open up an app on your phone and check the value. You don't get a statement every single month that shows you what it's worth. And so, you just don't really worry about it. So like, it just seems like it just goes up. And so, when the markets, when the public and liquid markets are going down in something like April, there's nothing to look at. You just be like, well, it's either 100 or it's 0. It's like, and no one's told me it's 0 yet, so it must be 100. And that's what's being sold as a benefit, but that's like, the old saying, right? Like, it's not a, it's not a bug, it's a feature, right? But it's not a feature. It is like a bug in this sense, right? So, there's, I don't know, is that how they positioned it in your program? Like add it to your portfolio because you can't look at it?
So we covered a couple different aspects of it. We actually even ran a live case study. And there was some gentlemen from a pension fund and such. And I think that, to the extent that we were kind of meshing institutional asset management and personal asset management. There was kind of like, we weren't really drawing that line because I think those are two very different things.
Mm-hmm.
And I think it maybe a little bit more emphasis on that would have served everybody well, or at least these younger people, right? Because I feel like when you're in an MBA class or you're in a master's program and you haven't really had that work experience, like you and I have both been working for a decent amount of time, right? We've formulated our own thoughts around things. We've seen things in practice. It's a lot easier to just take what a professor's saying at face value. And there's nothing wrong with, I'm not saying like, don't believe your professors and stuff. That's not what I'm trying to get at. But
I often am.
Yeah.
But
to the extent that, you're not going to go double check, or you're not going to go, draw your own conclusions from things. I think that's where, might be a little dangerous, right? Like we should be formulating our own thoughts, not taking everything at face value. And I think that, that was really highlighted when I had the discussion with my group, when they were like, dude, like, thanks so much for saying it like that. Like, we didn't really get any of that from class.
Yeah. What are some of the cons that you helped highlight for them or help them understand? Like, man, what are the drawbacks of some of this that people don't talk about?
Yeah, 100%. I think that, we didn't really discuss the extent to which leverage is involved in these funds, how much leverage is allowed to be involved in the funds. That was kind of glossed over. Bringing that to light, letting people like know that that's a thing. Like, hey, we're going to go identify a fund. We should, also see how much leverage that they're willing to take or have the ability to take. That was one thing. Tons of people, I just in the presentations and such, really drove home the idea of the illiquidity premium. Somebody had even touted, the idea of mitigating or smoothing volatility and such as this really great thing. And I'm like, if you say it is and you believe it is, then sure. But I think it's also important to highlight some of the drawbacks associated with that. I know that, we kind of exchanged on DMs, what was it, yesterday or the day before, about, one specific thing being listed. And I think that kind of highlights some of the, potential downsides.
Yeah. So So like my handle on X is stored alpha, right? And it's an old joke. I think it actually came out of like the Pimco shop originally, like way back in the day. And it's sort of this idea that like on paper in the here and now, maybe the manager's underperforming, but like the alpha is there. It just hasn't been realized yet, right? Like but it'll rear its head, right? It'll come through like the deep value sort of idea, right? Like it'll pay off, stay with it. So I kind of poke fun at myself with my own X handle, but somebody pointed out to me, it was actually Chris Gitter pointed out to me, he said like private credit is sort of this like similar idea, but it's stored volatility. So people talk about this idea where like private credit can smooth your volatility or private investments can smooth your volatility. And like it can, right? Like in an April scenario, like tariff tantrum and the public markets are getting hammered and your private investment isn't getting marked to market and it's not getting adjusted in price because, what it's doing is it's storing the volatility. And at a certain point, what we saw this week in the public market is when a private asset got listed on the public market. And so you were just simply an investor in a fund. And in this scenario, like for anyone listening, it was a private investment fund that had what's called an NAV of $24 a share, net asset value of $24 a share. And so if you had been checking your statements saying, or whatever, and saying, what's this worth? They're saying $24 a share. And it's always worth $24 a share, but you get this nice dividend payment every month, right? It's always $24 a share. Not always, but really, really, really close, right? And all of a sudden it turned to what's called a closed-end fund, which simply means, hey, they're going to stop issuing new shares of the fund and the fund is now free to trade on the stock market. So I think in this case, I'm pretty sure it launched on the New York Stock Exchange as a closed-end fund. But what that allows is for now everyone to freely buy and sell the fund. There's no create or redeem function. So it's not pinned to the NAV. And so what it does is it allows the market to actually price it to its true market price. And within the first, couple minutes of trading, it priced from $24 a share to $16 a share. it was a 38% loss. And so, you've been thinking for, the last 2 years, oh man, look at, I'm making 9% a year, right? In these nice, dividend payments or whatever. And all of a sudden you're down 40% on what you perceive to be a safe investment that was supposed to be smoothing your ride. And now all of a sudden you get wrecked once it can trade and there's the true price discovery, right? What's super interesting about that particular investment did you look into the fee structure on that at all?
I actually didn't. I saw the viral tweets and I was like, oh my gosh, like this is pretty much what we're talking about, but I didn't have time to actually go through the fund.
So check this out. They're still billing their fee on the net asset value as they market. So it's not based on the traded value per share. So they're still billing their fee, which is a high fee to begin with, on the $24 a share effectively, right? And so with the current drop in the market pricing, it's now like a 7% annual fee.
I'm so happy that you brought that up.
In private credit, it's like, that's crazy. But again, it's like it's technically it's a closed-end private fund. They play by a different set of rules than just the old plain Jane mutual funds and 40 Act funds and ETFs, right? Nuance difference, but you got to understand it. And, that's the effect of, again, what do you even own in that, right? You don't really know.
Well, that's exactly it. And I think that when we get into, really, like you said before, really pushing, volatility smoothing as a feature, am I allowed to make the argument that like, hey, if I just turn my Wi-Fi off when the market gets volatile, like, is that volatility smoothing as well? It's just, it's interesting to me that it's being packaged up as such like it's such an awesome thing. And I'm not saying that it's a bad thing. I'm not saying it's like good or bad.
No.
I just think like constantly bringing this idea up of like, oh, well, you can't see how much it's worth, and you're going to be less likely to make an irrational decision, or the redemptions or the liquidity is 5% of NAV on a quarterly basis, so you can't actually do anything. We see illiquid assets or relatively illiquid assets all the time. I think that's why people see such significant. That's why home values are such significant portions of people's net worth, because they don't turn around and sell it on a moment's notice. 401ks are a very, very similar thing. It's, kind of a set it and forget it. It's going on in the background.
Yeah.
Is there an illiquidity premium associated with a 401k or a retirement account that, no. I guess you can't get money out of it, but you know what I mean?
Yeah. Well, illiquidity premiums don't matter until they do, right? And the other thing too is like people always forget, like everything's liquid till it isn't, like so when you talk about private investments, there's always people that say, well, yeah, if you really want it out, one of our other LPs would just buy you out. It's like, yeah, sure, if everything's great, but if everything's great, do you really want your money out? You want your money out typically like when things are not always that great, and it's in those times that it's like no one else is stepping up to the plate. No one else wants you. Right. And you talk about private investments. I had a friend recently that was looking at doing a private investment and sent me some documents, and I reviewed them, and I just called him back and said, hey, like first thing I just want to talk to you about is, do you know what a capital call is? And he's like, no idea. And I said, like, it means that if this investment starts going sideways, they can demand that you put more money in. And if you can't put more money in, you get not only diluted, but you get diluted at a 25% discount, which means you get diluted and take a 25% loss for somebody else having to, cover your portion. Right. And that sucks, dude. Right. And it's like, most funds probably won't do a capital call, but let me tell you, on private real estate projects in particular right now, I think the chances of somebody getting capital called before these projects are done is getting increasingly larger from just a fundamental observation, right? I think the risk is becoming more and more apparent, which no one ever talks about until the hindsight, but there's a lot of stuff. And I've just seen, I grew up around the industry, and I've seen how private and illiquid stuff ruins people's lives. I mean, it truly can, right? But in the same time, it has its place, right? Like there is a use case for it, but you have to sort of earn that seat at the table.
I 100% agree with that. I think that That's very well said. Earn your seat at the table when you begin to consider private investments. I think that was one of the main issues that I took with so much emphasis on private assets, in these MBA classes, was that, there was really no point driven home that, like, yes, exactly like you said, earn your seat at the table to be at a private investment, or be in a private investment, and really understand, like you said, capital calls. Like there's just so much stuff that I feel like we could have emphasized throughout the course, versus just, looking at returns, looking at, private assets
Yeah.
shrinking, small and mids, like people are staying private longer, and things like that. And those are all great things to go over. I'm not saying that, those are bad things. I'm just
Yeah.
saying I think you should have also been covering, some of the potential drawbacks.
Yeah. Yeah. I think that's totally true and accurate. And it's just, it's overlooked. I mean, my perception of it is that I think this is late stage behavior. I think it's late cycle behavior, right? Where, it's not being sold that, hey, private equity is, difficult to access. There's not always a ton of deals out there. They're risky by nature, and thus they carry a big illiquidity premium and a risk premium. And so the returns are outsized, Now, hey, we're making investments that can go to zero, but if they go well, we should be well compensated for them. Right. And I think that's, that's when private equity and private credit is healthy investments, right? I think that's the healthy investment conversation to have around it. And when it's now being sold as, hey, everyone should have it, right? Everyone should have it at least a little bit somehow, wherever you can find it, whatever the fees are, whatever the cost is, whatever the return projections. And the benefit is it could help smooth the daily volatility of your portfolio. Like, man, that is, you're trying to line up bag holders, in my opinion, right? I think from a sentiment perspective, you're like, that's not a great indication of being in a healthy part of an economic cycle, right? Hey, it's no secret to us. We look at the demographics of this show. We know that a lot of you listening are actually other financial professionals and other investment advisors. We want to go ahead and invite you, if you're looking to do something different in your career, go ahead and reach out. We're always looking to bring on high quality people that understand how to do the planning process, align with our values, and are looking to deliver high value to their clients. Please just go ahead and reach out to us. You can get us on our website, ducharmewealth.com, and we look forward to talking to you. Here's the other thing about private investments I always try to point out to people, like when we're talking about behavioral finance, or I have people that say that there's an old saying. Have you ever heard the saying about IPOs? Like, so if you can get access to the IPO, you don't want the IPO, right? Like, dude, neither of us are billionaires, right? Like, why are they giving us access to the IPO? It's like, you don't want to buy that. It's going to get smashed when it, goes public. It's not a good deal, right? If it was a good deal, the big guys would have taken it, the people with unlimited analyst resources would have bought it. Well, it's like the same is true for private investments. It's like, dude, if you can get access to it, do you really want it? Like if you got $50,000 and they want your $50,000, do you really want in on that investment?
It's funny you say that, because that's another thing that I'm just like starting to take from the industry. I'm sure that, your inbox is similar to mine. Constant emails, on a daily basis of something new rolling out. And it, like, even to the extent that we were talking about, that exclusivity, is it exclusive anymore? No. I don't know. No. Like, if we can all get our hands on it, how private really is this?
Yeah. Well, and I'll say there's an app out there that allows you to it's almost like a Robinhood type app, and it allows you to invest in private investments, private real estate deals. You probably know which one I'm talking about. But what people don't realize is that each one of those investments will issue you their own K1 every single year, a tax form K1. And so what this creates is, if you don't know those forms are coming because you don't even know what a K1 is, prepare for your audit because it's coming, right? And if you do know what a K1 is, then you probably also know that, like, anyone that gets K1s, you file an extension every single year, right? Like, you will delay your taxes. And so a lot of, if it's a bigger investment or something and your K1 is material impactful to your investment, to your return, or like your tax return, It's really annoying. But also like if you're paying your accountant to deal with K1, that is like, oh, $34 of pass-through income. And by the way, now there's like a foreign bank attached to it or something because the private investment held some foreign bank account. And so there's $1 of foreign investment income and and so now you're like, hey, you made great. You put, you put your $100 in and it was a 35% return on the year. So you got $34 back and you just paid your accountant $300 to deal with the K1. It's like, it doesn't even, and then imagine if you have, you're like, well, I'm going to be diversified, right? Everyone kind of understands, hey, be diversified. So they buy 6 of them, and now you just built yourself, like an $1,800 tax bill from your accountant to deal with all the K1s and file an extension. And you made, you effectively like just lost a bunch of money in not even fees of the fund, but fees of having to deal with the administrative impacts on your tax return. And
Yeah,
like, go ahead.
that's real world. You know what I mean? Like you're breaking it out at how it works in practice, not in concept. And that's another thing that I'm sure, like in your program, some things sound really awesome in concept, but in practice, it's just different, right? And it's hard to like tell people that or explain it to people that really haven't seen in practice. Like when you bring that up, that's the first thing that I think is like, oh my God, your accountant's going to hate you, or it's just going to cost you a ton of money for what percent allocation of your entire portfolio was really in there, right?
Yeah.
Like the actual real world mechanics of that are just less like realistic.
Yeah. Even like $50,000 or $100,000 can be an underwhelming amount of investment in those type of investments relative to the complications it can introduce to your financial life. Right. And then you pass that all through the lens of, by the way, I call that metric, I call that return on hassle, by the way. So it's got a really, really poor return on hassle.
Yeah.
And then like, what's the risk you're taking? And it's very difficult to quantify the risk, right? So it's very fundamentally driven and you have to be really convicted in the fundamentals of it, right? So you got to do really good and deep fundamental analysis if you're capable of that. I would say the exception is maybe if you're going with hedge funds that are trading like liquid instruments, and then that's a whole different skill set to try to evaluate that type of alpha. But it's super weird, like that people don't have these conversations. They just want to jump right to, being able to brag about their investment at the cocktail party, right? Because I get it. Like I'm the wet blanket guy, right? Like Cliff, you don't know about if you haven't figured out by now on X, right? Like I'm the wet blanket guy. No one likes the wet blanket. It's like that guy, he just likes, he's boring, right? It's like, yeah, sure, gold sounds boring until there's a year with a 65%. It's like, small cap international or whatever, like, bonds are great until they do okay in a year, right? It's like all this stuff is the stuff that's not, it seems boring, but it's prudent, right? And a lot of it is really just about prudence. And I think the thing that really holds people back in their financial lives from getting to a good level of wealth that that then impacts their life in a really positive way and allows them the freedom and framework in their personal lives to really start working on passing that wealth on to their kids, if that's a meaningful endeavor for them. They complexity inhibits that, right? So like owning an index fund isn't super exciting, but you're now able to spend your time on stuff that's like more important in your financial life, in your professional life, all this stuff that allows you to say, okay, well, how can we leverage this and get the most out of it? And I think kind of pound for pound, when you measure that net of all the return on hassle, return on cost, the risk return ratio, it's actually like pretty attractive. But again, wet blanket guy. So,
No, 100%. And I think, maybe that was one of the other issues that I kind of took in the class is like just a general understatement of everything that we've just discussed. And I get that, we want to cover this. We want young people to know what private assets are, because obviously it's pretty relevant to today's day and age. We see it. These are people that are looking for jobs. They should be aware of it, maybe a potential job for them in it, things like that.
Mhm.
But there was a few times where I was sitting in class scratching my head, like, are we talk about anything like, what are we doing here? Like, what's going on?
Yeah. Yeah. You know, I'm big on transparency. Do you get the sense that like a lot of people that you work with, they're very interested in transparency?
Oh, 1,000%.
Yeah. I, I find that the people like, it's funny, the more money people tend to have, the more that they care about transparency. And it's because they want to know what they own. They don't necessarily care what they own. They just want to be able to know what it is, right? Like what, you know, I'm not a big fan of like what people call line item risk, but I think generally they want to be able to check their account at a third party custodian, like, we custodian typically like a Charles Schwab, or, people might use Fidelity or whatever. And they want to be able to check and say like, what do I own in here? And can I point to something and say, why do we own this? Right. And is there a good reason why we own it? Right. And that's the transparency they're looking for, not, like, well, we've got that, but then there's this private investment over here or there. And we don't really know what they're doing or what they're invested in exactly, but here's what they said. And the brochure always sounds great. It's like, until you find yourself in an economic situation that you're going, what's our risk exposure on that? Yes, we put 100,000 in that investment and we think it's worth 100,000, but we're looking at, like in 2008, you'd be looking at it going like, what is it really worth? And you're sitting there going like, put 100,000 in and we literally don't know if it's literally zero. Right.
Yep.
And going back to illiquidity premium, the reason why you need an illiquidity premium, even if you say like, well, my life's so set and solid, I won't need these funds. I'm super high income earner. My job's super stable, whatever. I've got plenty of assets. My house is paid off. I don't have debt, blah, 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 blah. So I won't need the assets back. Well, the illiquidity premium is like, have you thought about this, Cliff? Is like, yeah, but you can't rebalance when you want to. Right? Like you can't, so like even if your private investment is like 100,000 and in '08 it stays 100,000 and didn't go, belly up and blow up in your face. What you couldn't do is be like, hey, I want to sell half of that and I want to buy all this other stuff that's on a mega sale. Right? Like you can't do it.
No, 100%. I think that, you're hitting the nail on the head, as far as like, especially talking about like psychological things or like real world applications. Because that's a very real thing, right? Markets get volatile, or you want to rebalance, or like you whatever it may be, and now all of a sudden you're limited in that, and do you want to be limited in that? I think that's something that should be highlighted.
Yeah, I think these are all points of discussion that should absolutely be highlighted. Any other major thing that you're kind of thinking about, or as you're discussing with people or looking at private investments or thinking through this stuff, and whether it's, in a academic graduate program setting or, in real world practice?
Yeah, no, definitely. So in real world, we work mainly with younger professionals. We're focused on building, publicly traded. We use broad-based, exposure across markets for risk-adjusted, market exposure. I know that you guys have a slightly different approach to that. It may be a little bit more active and such. But for me, working with younger people who may be getting their first experience investing, allocating money to markets, I think it's incredibly important to have a baseline so that you can become comfortable, right? Like we talk about psychological aspects of investing and dipping your toes in the water, learning what volatility feels like, knowing that your funds are invested, things like that are important to build that baseline. Well, yes, as far as the privates go in the academic world, we finished up our class. Everybody gave a presentation on it. It was fun. There was somebody there from a private equity fund who was like a guest judge of the projects. My team did. We did great. Trust you. We got 100. So we were all set. we were good. But I'm happy that's kind of done and dusted. And I guess we'll see if it comes up any more classes. I got one more semester left of my MBA, and then I'm done. So
yeah, well, you're probably a better student than I am. I wouldn't have been able to stomach it. I famously in my portfolio practicum class in my undergrad shorted the market, and I was the only group that we made money that semester. But again, like, I'm a willing to buck trends, right?
Yeah,
so
no, well,
you're probably a lot more
thing,
palatable
right?
to have in class than I am.
What was interesting, right, Brandon, is that we got to do this. We got to create everything. So we got to create a mock client. We got to create a mock, risk tolerance. So we tailored it to them because, like we were talking about before, like it can be applicable. Like this isn't
Interesting.
like I'm not saying like good or bad, but there was some significant deviation in the client that I chose for my hypothetical proposal versus the it teacher and their 403b that somebody else presented. And that's where I think there was that discrepancy in the actual real world application of a product like this or an investment like this, right? Like
Yeah.
I got to choose that my individual was younger, significant assets, incredibly high earner. I got to choose all of those things and I purposefully did that.
Mm-hmm. Well, okay, there you go. Yeah, and it sounds like you're describing a really great use case, right? Where it becomes a diversifier on the edges, a potential point of alpha, and you can take some of the manager risk, right? There's the selection risk on that. I'm curious what you put the net worth and kind of assets on to justify that, in your opinion.
Yeah, 100%. It was a 35-year-old individual. In all honesty, and again, this is a hypothetical recommendation. We carved out a little bit of a mid and small position that would be just allocated to an index because it was a mid and small focused fund that we had ended up choosing. Assets were north of 10 million.
Assets were north of 10 million.
Correct.
Yeah. So if you're 35 and have more than 10 million, you may consider yourself as somebody that may think about doing some private investment stuff. I think that's what Cliff's saying, right? A lot of hedges in there.
we tried to like drive the point when we made our delivery in that, like, look, this is not your everyday investor. This is not somebody, and that's another thing. I think that maybe people might be biting down too hard on right now is the idea that, like, look, this is something that needs to be there. I couldn't have access to it, and high net worth individuals could, right? Accredited investors could have access to these things. Now I can. It's my time. And it's like, well, not necessarily, right? It's not a necessity. And it's on a case by case basis.
Well, it's like the old saying, right? Once the trade has a name, and the trade's generally pretty close to over. It's like once everyone has access to private investments, I think what you said earlier is it really private? Is it really like exclusive? Is it really, is it really unique? Is it really, going to give you the illiquidity premium? Is it really going to give you that edge because not a lot of people knew about it? And I think the answer is like no. Truthfully, I think like the easier this kind of stuff is to get, the easier it is to raise capital on this, and the more people you can market it to, and the more assets you can raise, you just end up with more. You're buying more obscurity that you really can't track or hold accountable in a significant way. It's less regulated. I think there's some concerns, just my opinion.
100%. And those are all like palatable concerns. Like you would ask that of any investment, right?
Yeah.
So like, I don't think that there's any allocation in a portfolio that gets a pass.
Yeah.
But why would we just give it a pass? I think that, obviously you want to run due diligence on anything that you're going to allocate your hard-earned dollars to, whether that's private, public, whatever it may be. And I think that, we might be glossing over some of the things that could potentially go wrong and maybe some of the cons to an asset class.
Yeah. Well, I think the big takeaway is, do the easy things first, do the simple things first. Right. And as you grow your net worth with the easy and the simple things, the bigger opportunities may be an opportunity in the future, but what's that? Like you'll probably know when it's time, right? If it feels forced, maybe here's a good way to think about it. If it feels
100%.
forced, it's probably not time,
Exactly. That's exactly it. And I think that, the more that people like you and I can create some awareness on that end, I work specifically with younger people. And there is like an allure to some of these things. And sometimes we have to reel people in, be like, hey, look, let's walk through what this actually looks like in practice. I think, throughout our discussion today, we kind of highlighted that, right? Like like it is a little bit more in depth than just like, hey man, I want to add some privates to my portfolio. Okay.
Mm-hmm.
Like what does that look like? In theory and in practice are two very different things.
Yeah. Well, I appreciate taking the time, Cliff. It was awesome to have you on. I look forward to having you on again in the future. You know, it's always good to have the opportunity set to talk with, you know, high quality, you know, CFPs and professionals at other firms, like just outside my own, you know, my own space. Right. And, collaborate. It's always fun. I appreciate the time.
Yeah, no, Brandon, thanks so much for having me on. It was awesome. I had a blast. You know, we'll definitely have to jump back on. We'll see what the market brings us, and then maybe we'll have another hot topic.
Yeah, I think I think you know, you're kind of a behavioral finance guy, and that's always an interesting thing. And I think there's probably more to explore around that. I think 2026 though is going to be interesting. I think it'll be interesting.
Yeah, interesting to say the least. I feel like these last, you know, I'm sure you'd agree. These last 5 years, as I've been, you know, coming up in the industry, have been a great time period to kind of cut my teeth. We've seen some pretty crazy things, and I think it makes you a better advisor. The more experience that you have, and the more that you can, you know, coach people through things, and it's all good. You know, we'll see what 26 brings.
Yeah, I think it's going to be interesting, but I don't know directionally which way. How about that? Right.
Yeah, I'm with you there. That's pretty much all my market takes, though. I'm like, yeah, that could probably happen. I always think of I don't know if you're an Office fan, but when Jim is asking Dwight potential scenarios for the world to blow up or something, and he's like, very high possibility. I could see that happening. Yeah, maybe that would happen. That's me on a lot of these market takes. I think it's really hard to, you know, especially over super short time frames. We're talking a 1 year period. To know how that's going to end up. But yeah, that's me.
Yeah. Well, it's why you got to go do a CMT program.
Yeah. You know, it's funny. Maybe I will. I might have to sign myself up. It's something that I would definitely consider. I got to get through this tax planning designation, finish up this MBA, and then, you know, maybe I'll be off to the races on the CMT front. Yeah.
Keep the education going, man. It's good and valuable. So, all right. Well, hey, thanks again, Cliff. And, we'll see you out there. I think I'll be probably back out in New York again sometime this next year, and I'll make sure to give you a ring.
Yeah, keep me posted. We'll get out for a drink or a coffee or lunch. Would love it.
All righty. See you soon, man.